Welcome to Talking New York Real Estate with Vince Rocco. Our show is all about the exciting world of real estate and in particular, how it relates to the luxury New York marketplace. But if you are not planning a real estate transaction in New York, we still have plenty of information you can use no matter where you are. Now, here's our show.
Good morning, everyone. I'd like to welcome my listeners in the United States and all around the world. I am Vince Rocco, and you are listening to Talking New York Real Estate at this hour. So, how do you predict the various markets and their activity in New York City real estate? As a global city, New York City is ever evolving. The demand for real estate is always influenced by factors such as population growth, economic conditions, and lifestyle preferences. Keep an eye, though, on emerging neighborhoods, changes in demographics, and shifts in the job market to gauge potential demand. Advancements in technology are also transforming the real estate industry. Smart buildings, sustainable design, and energy-efficient features are becoming increasingly more important. New York City's extensive public transportation system plays a significant role in real estate trends. As it improves, there will be more demand in certain neighborhoods, but the lack of affordable housing has been a persistent problem or an issue in New York City, and it is anticipated that the city will continue to address the challenges by implementing policies and initiatives that will enable us to get affordable housing in a better condition. And finally, pricing, interest rates, and an overall malaise in New York City market is showing trends that have been the worst in many, many years. We will have all that and so much more as Talking New York Real Estate gets underway on this Tuesday morning. In the news this morning, President Biden signed a bill last week to keep the government funded through November 17th. The U.S. economy added 336,000 jobs in September, significantly more than the Wall Street economists had predicted. The unemployment rate remained at 3.8%. But economists had forecast that the U.S. would add only 170,000 jobs and unemployment would stay at 3.7. While strong job gains are normally welcome, the report likely raises issues that the Federal Reserve will raise interest rates again next month to tamp down job and wage growth that could be fueling inflation. Consumer confidence, though, fell in August as gas and grocery prices pushed higher. Consumer spending was weaker than originally stated in second quarter of 23. Mortgage rates rose to their highest levels since 2000, clocking in at 7.7%, and I believe 8% is around the corner. Florida has surpassed New York as the nation's second most valuable housing market, according to Zillow. Harry Macklowe landed a $300 million inventory loan for the many unsold apartments at his One Wall Street development in the financial district. The project, long delayed and slow selling, will test investor patience as Macklowe hunkers down on the pricing for its larger units and tries to wait out the current down market. The famously mercurial developer has turned down numerous would-be buyers in the building who recently made all-cash offers, according to people familiar with the project. He's just not being flexible. Leasing activity jumped 26% from the second quarter, while demand more than doubled in Lower Manhattan and grew 43% in Midtown South. But that's a caveat for most of the positive metrics. The most important one shows that a hard truth still remains. Available office space is at an all-time high of 19.4%. The report covers Lower Manhattan, Midtown, and Midtown South. No three-month period will turn things around, said the author of the report. There will not be one quarter that gets the market going from challenged to recovered. And every borough in New York City now has a beach. Well, sort of. On Monday, the Gansevoort Peninsula officially opened at Little West 12th Street and 13th Avenue in the Hudson River Park. The new 5.5-acre waterfront park in the Meatpacking District includes a sandy beach with umbrella chairs, places to picnic, kayak, and do anything else you would do normally at the beach, but swimming will not be allowed because the water is polluted in the Hudson River. And finally today, what's a better pairing than, this is my favorite story, better pairing than pudding and pastrami? New York City's icon, Katz's Delicatessen, and Magnolia Bakery this week announced a collaboration on a meal package that includes beloved menu items from both institutions, now available to ship nationwide for a limited time. New York Classics, as the bundle is being called, includes 2 pints of Magnolia's banana pudding and enough Katz's hand-carved pastrami, corned beef, and sandwiches. that people are just going to love, including myself. Well, I'll be. All right, with me today are Steve Kliegerman, president of Brown Harris Stevens Development Marketing, Ian Slater from Compass, Ari Harkov with us on Zoom from Brown Harris Stevens, and Greg Heym, our chief economist here at Brown Harris Stevens. Welcome, everybody, and good to see you all. Ari, thank you for joining us today. I really appreciate it. Greg.
Thanks for having me.
You're welcome. Greg, let me start with you. So, as I reported at the top of the show, while strong job gains are normally welcomed and the September numbers beat all expectations, the report likely raises the odds that the Fed Reserve will raise interest rates again next month to tamp down job and wage growth that could be fueling inflation. I mean, honestly, I just don't get any of this. Why does it not help when more people are working and more people are out there spending money, but yet the economy is still in the crapper?
Well, think about what you just said about consumer confidence. You know, there was an article the other day that even with this amazing job market, near record low unemployment rate, this now over 9.6 million jobs available out there, people are still not feeling good about the economy. The reason is inflation. And it's always the most serious problem you can have in an economy. I always use this. I've used this on your show before. It's like termites in a house. You have inflation, everything else gets put on hold, you have to get rid of it. So it's one thing to say, well, what's the problem? More people are working, that's good. The problem is the spike in oil prices is supply driven, but you can't expect to not have inflation if you keep rates lower than they should be. It puts more money in people's pockets, but were people better off before this rampant inflation started a year and a half ago, 2 years ago? A lot of people were. And I think the other thing is if you keep rates too low for too long, you basically are encouraging speculation. Remember Alan Greenspan, irrational exuberance? Think of credit default swaps, think of the tech bubble, or basically any Wall Street crisis you want to talk about is usually caused by the Fed keeping rates too low for too long. So it's strange, even in real estate, these numbers are hurting us because the better than expected performance of the economy is pushing the long-term inflation expectations higher, which is pushing mortgage rates towards 8%, which is killing us. So you don't want to root for a recession, but we all want that Goldilocks economy, not too hot, not too cold. Right now, things are too hot because the Fed was going to do one more hike before this jobs report. They said it after their last meeting. The question is, what happens next year? And they pretty much said, not only are we going to raise rates probably one more time, but we're not going to expect to cut rates as much as we thought next year. So the bottom line is higher rates are here to stay for at least, the next 6 months or so. You're not going to notice any significant decline in rates until we either hit a recession, which is looking very unlikely anytime soon, or the economy cools enough where people feel that it's under control. And I know your thoughts, a lot of people probably have that. Why would we want to ruin this great job growth? Because you're not going to get prices down. Consumer spending has stayed positive only because it's not adjusted for inflation. If you adjust retail sales for the price increases, it's actually negative. People are paying more for less stuff. And that's untenable, especially when people owe $1 trillion in credit card debt. The pandemic excess savings is essentially used up. Something has to give. And the Fed can't worry about the damage it's doing. It waited too long to act, and now we're all paying the price for it.
Well, that's my point, too. It waited far too long to act. But, playing devil's advocate or, reiterating what people say to me on a regular basis. So why can't we just raise rates to where the Fed thinks it should stop,
but the Fed
8%, 8.2, and then work from there? What happens is, though, I hear what you're saying, but what happens is people get spooked every time they decide, all right, so the rates are at 6.5, so let me see if I can do something, buy something now, whatever. And then by the time they go through a transaction, it's 7.1 or 7.2. So it's stopping, I believe, consumers, and you guys can help me out, it's stopping consumers from doing anything because they're buckling down and digging in until someone up there says, all right, this is the last hike, this is the last number increase, done.
Well, they're not going to do that because they have
Clearly.
to. And plus, the Fed doesn't go, okay, rates are now this, and then they're that. They have to go in. The one rate the Fed controls when they do these hikes is what's called a federal funds rate. It's not really even used anymore because I won't bore you with excess reserve systems. But to change a rate, the Fed either goes out and buys treasuries from banks and people that holds them to put more money out there, or sells them to take money out. It just doesn't say the rate is now that. And that they have to go in and move markets, and that changes things. And again, it's worth noting, and I think real estate brokers have to always tell this to their clients, what the Fed does has no direct correlation to 30-year mortgage rates. Zero. They're actually bringing up short-term rates to slow the economy, but at the same time, we're seeing long-term rates go up. That doesn't always happen. In fact, you would expect the reverse to happen. As we slow the economy now, you'd expect less inflation in the future. And, but the problem is we have an inverted yield curve. We've had one for a while, and that frustrates people. I get the frustration. As an economist, I'm embarrassed for the Fed and the way these things work. But I think that people have to understand we're in this situation now. It takes time. Anything they do takes 6 months to a year to begin to even work. So there's a lag, too, to every one of these hikes.
And we're seeing that lag in the real estate market right now.
We're paying a price for it. I mean, it's
well, as I
certainly
said
rough.
at the top of the show, we're sort of in this malaise that people aren't quite sure what it all means or how to get out of it. Ari Harkov, so from your perspective, while interest rates, and we'll talk a little bit more about interest rates in a minute, while they continue to climb, elevating borrowing costs, home prices have not shown any signs of weakening, okay? And that's sort of what a lot of consumers out there, a lot of buyers out there are waiting for, hoping for. Well, maybe I'll wait until the prices drop. Maybe there's going to be a plummet in the industry. What is your professional opinion on why, we have not seen any signs of pricing coming down?
So, I mean, the thing I think people that are outside the industry don't realize is the majority of buyers are sellers and the majority of sellers are buyers. And so if you remove first-time home buyers, you remove second home buyers, investors, what have you, and all of those make up, segments of the market. But the majority of sellers are buyers and the majority of buyers are sellers. And so they both operate in the same rate environment. And when you have a large jump in rates in a short period of time, and you have a lot of homeowners sitting on very low cost fixed rate debt, because we're in a long-term fixed rate, debt environment in the U.S., which is different from Western Europe and different from Canada and Australia and a lot of other, Western democracies. You're in a position where a lot of owners say, I either can't afford to or don't want to trade out of my inexpensive 30-year fixed at 2 to 3% and buy a new home at 6, 7% or maybe even 8%. And so they don't sell, they don't list. And so what happens is when inventory is constrained, you have less supply. You go back to Econ 101, less supply. Demand has remained relatively constant because you have, strong consumer balance sheets and overall a strong economy and a strong labor market and what have you. And so demand is constant, supply is low, and prices don't go down. The thing that we need in the U.S., and this is maybe too big of a conversation for this podcast, is we need more supply. We need more housing. The U.S. has the housing shortage. We need to build more houses. And the inventory is not going to come from resales in the rate environment that we're in right now. So the long and the short of it is we're in a low inventory environment in New York City. And if you look nationally, we're in an unbelievably low inventory environment. And so prices aren't coming down. And we're in this kind of weird mix where if rates come down, you'll see inventory pop, but you'll also see demand pop, and the two may just cancel each other out.
Yeah, I I wholeheartedly agree with that. So Ian Slater, so let me ask you, you represent, like Ari does, a lot of sellers out there. So and I do as well, more than the buy sides. When you're talking to sellers today, we obviously need a lot more apartments on the market in the city. We need more housing, as Ari said, in the country. What are sellers saying to you today, other than what Ari mentioned about the interest rate? Change. I'm at 3% now, 4% now. If I do something, either upgrade or downgrade, I'm going to be at 7% or 6, whatever it is. What are they telling you today? Their hesitation is on listing now and just moving forward, and thinking about the future. Whenever
it's the obvious problem. They want a higher number for their apartment than it's probably worth to make them move. So I have a lot of sellers that just say, or people that want to move, and they call me and they say, I tell them what it's worth, and they say, well, then it's probably not worth it for me to move. I actually had someone yesterday ask me, okay, I came to him. I said, someone wants to buy your apartment. You know, we do a lot of things off market. I said, someone wants to buy your apartment. He said, okay, then he can also give me a loan at 4% to buy my next apartment. So I don't have to go get a mortgage, which I was like, that's an interesting thing. That's an interesting proposal. And that's actually kind of smart. I'm also going to say, I think that there's like a 3-month look back of a lot of this data. And just since Labor Day, I've started to feel prices softening in the city. I think a lot of sellers are getting more realistic. I think people are negotiating more. And I think that prices, if you look at the next quarter's data, you're going to see a higher amount of negotiability for absolute sure.
Yeah, good. But what about the initial on the market price, though? I mean, for example, as I was coming in this morning to the studio, I got an email from one of my clients who we started a conversation about 2.5 months ago on listing their apartment. And of course, as you just said, well, I want more than that. I think it's worth more than that. Why can't we ask more than that? You know, the typical story, right? And I kept saying, no, you can't. And I think I did for the first time, and I've been doing it a lot more lately, putting together a spreadsheet of financial analysis, trying to explain to them why you can't, based on all of our data. And so I finally 2 months later got an email this morning. Okay, we're ready to list. Let's talk later today, and let's figure out a strategy. I'm assuming they're going to go with the price I suggested. Now, one of the things I also have to point out is with a reduced asking price, there's always room for negotiation, right? Always negotiability. So how much more off that asking price is a seller going to want to go? And that also stalls
the buyers
market.
Always in New York want discounts.
Well, they always do, but one of the things is the market lags, apartments lag on the market, and people get very sketchy when an apartment is on the market 5 weeks, 6 weeks, 3 months, 5 months. They're all of a sudden it's like, well, what is wrong with this place? Okay, so now you've got that to kind of take into consideration. Are we in a buyer's market? Because I've read something the other day. I'm always kind of saying, look, we're always in between. We're always, in that quagmire of, it's a strong seller's market. It's a strong buyer's market. Right now, who knows where we are. I read something the other day where I forgot who it was declared, our wonderful news media declared that we are in a strong buyer's market. And all I keep thinking is, how is that possible? Really?
Well, there is a statistical gauge that you use, and that's the month's supply of inventory. Because if you say there's 7,000 apartments, let's say, available in Manhattan, I'm not saying that's a number now, let's just say that's what it is that a lot? And the only way you can answer that question is relative to demand. So what you do is you look at inventory and divide it by the average pace of sales. Overall, the market is showing neutral right now in Manhattan. But as you go up, that changes. And as you go down, that changes also. So anything under 6 months is typically considered a seller's market, and things are moving quickly. Anything sort of over 7 months is considered a buyer's market. But, these ratios don't always hold fast. Obviously, we've seen a big uptick in luxury condo sales. I mean, the condo resales were incredibly strong, for the closings anyway, last quarter. $80 million ones, a bunch of $30 million ones. So, and those are your cash buyers.
Yeah, but those skew the numbers in the marketplace. I appreciate those big numbers, but don't they skew the overall?
But the fact that they're
they
happening,
skew the averages.
But they're happening.
Right,
But
they're happening.
Okay.
And I think it also depends on what sub-market you're looking at, because there's not one market in New York. There are multiple markets in New York. There are sub-markets in New York, and then you have the Manhattan market versus the Brooklyn market versus the Queens market versus the Bronx, and Staten Island.
neighborhoods.
Staten Island we don't do a lot, right? And neighborhoods within those. So there are so many different markets. Then there's the new development market versus the resale market, which is Ari was alluding to earlier, has very little inventory coming in the pipeline, and inventories are dropping overall.
Yeah, we're going to talk about that in a few minutes. But, as I always say about buyer's markets, and the audience out there is probably tired of hearing me say the same thing. When you're in a defined buyer's market, okay, where are the buyers?
I think
this is what amazes me when they
you're in a defined buyer's market when, as Greg mentioned, supply outpaces demand.
Correct.
And we're not there yet. And I see on the Upper West Side, I see one market, and on the Lower East Side, I see a completely different market.
But there is not clear. It's not a clear crisis, but you are most frequently, if you're above 2 million, the only buyer on the table. You are more than likely able to wait and negotiate slowly. I have more negotiations open now than I think I ever have in my whole career, because they take like sometimes months. And a lot of times you're the only buyer. I define that as kind of being a buyer's market, right? I tell my sellers they're not in the position of power. We might get lucky, right? You might have someone who comes in. You might have two people, but it's less than a 5% chance.
I know, but I guess you're right. You're 100% correct. But I guess, my thinking sometimes is when we are in a defined seller's market, we all know what that's about, right? Over asking price, multiple offers, bidding wars, et cetera. So I like to think, and I know I'm incorrect here, but I like to think that when we are in a defined, definite buyer's market, that the buyers are running down the street, with their hair on fire, wanting to buy something, regardless of where it is, what it is. Of course, everybody is price sensitive in this town, but, come on.
Well, buyer's markets, by definition, mean that not a lot of people are buying, right? So the name is ironic enough as it is. But
that's
it's also
the dilemma.
If you want to call it fear of missing out or whatever, it's a joke about stocks. They're on sale. Nobody wants to buy. There's a sale on in many parts of the city, where you can have a lot more negotiability, as Ian said, and really get a good deal. But then people feel no urgency to do so, or they're waiting for the rate or whatever. So you get this stalemate, and that's why markets take time to move. They don't move like that.
Yeah, if you're a Manhattan broker and you want it to be a real buyer's market, like, it needs to be a crisis. Yeah. There needs to be some external factor that causes the bottom to fall out, and it still doesn't fall out.
100%. Ari, before we go to break, I want to just ask you quickly, what in your opinion right now, in whatever kind of market we're in, is, in your opinion, a hot market? Where are buyers migrating to and buying up more of the inventory than not?
That's a good question.
I know, that's my reaction too.
I'm not sure that there is a hot market right now in New York City, I'm afraid. I mean, I would say, renovated townhouses, brownstones in Brooklyn seem to continue to kind of buck the market trend. So I would say but even that market, to be perfectly candid, and it's a market we're very active in, has taken a hit. And to Ian's point, the active brokers in the market are feeling changes, in real time. We're feeling on a kind of daily and weekly basis. And there's no question that in the last couple of weeks, the last month, there's been a shift. Absolutely. So I think you'll see that borne out in the data in the coming months for sure. But I don't think we have any hot markets in the city. I think that's the problem. I think that the constraints around supply and inventory are propping up prices. That being said, demand is also weak and is weakening in the rate environment that we're in right now. So I struggle to give you a hot market.
All right, we're going to take a short break, but we will be right back. Don't go anywhere. We're coming back. Okay, everybody, we're back. Steve Kliegerman. So new condo development sales have seen their good days, their bad days, going back and forth before the COVID pandemic. Where are we today in our town, New York City, okay, and what are the stats either way? Are we back on track? Because, again, in reading all the different market reports,
don't look at me when you say that. But
I love and trust your numbers.
Greg.
I tell you all the time. But all the different market reports from Compass, from Douglas Elliman, from Brown Harrow, I read them all. Corcoran, where are we market-wise right now for our beloved new condo development sales?
As we were saying, I think we're at an interesting time. Inventories are overall decreasing, although they ticked up a little bit in Brooklyn the last quarter because Brooklyn saw about 300 new condo units come to market. But going back to what we were talking about with Ari, actually, I think the Williamsburg market is still a pretty hot market for new condo development. It seems like whatever goes on the market there gets absorbed very quickly. Again, it depends on what neighborhood you're looking at, but overall, the lack of inventory is creating a little bit of an issue for buyers because they don't have much to compare. And when you don't have anything to compare, it's really hard to make that buying decision. So for instance, the Upper West Side, we have some conversions with lagging inventory, but the newer projects like 393 West End that we're working on, which is a conversion, those buyers are coming to that property after seeing some of the conversions that have been on the market for a while, and they're not sure how to make heads or tails of the market because everyone's pricing is different, because obviously if you've been on the market for 5 years, you're feeling a little deal fatigue and probably softening versus something that comes on now. But something that comes on now is literally brand new with today's highest and best technology and design versus something that came on 5 or 7 years ago. So, we've got a little over 5,000 total units between active and shadow inventory in Manhattan. About 25% of those units are actually on the market. That's not a lot of inventory.
No.
And in Brooklyn, we have less than 1,500 total new development units on the market. So, or in inventory with less than 1,000 on the market. So buyers are having a difficult time right now making a decision. The difference between the resale market and the new development market is that, as Ian was referring to earlier, the sellers in new development don't have that low interest rate protecting them from selling, right? So developers need to sell. So what we've seen at the very high end, we've seen a lot of negotiability, particularly on really high-end penthouses. A lot of deals in Hudson Yards went into contract last week. When those close, guaranteed you're going to see big discounts off of last asking price, which is already reduced from the original asking price.
Would you say the Hudson Yards overall has not been a successful development or seller? Not that we're casting aspersions or whatever, but
I would say
there seems to be a lot of inventory. It's overpriced. No one's really interested anymore, or from my perspective, seemingly interested anymore.
Well, the interesting thing is that it's actually absorbing units. The problem is that the initial projections on pricing were just completely
Out of
wrong,
control.
right? So, when you had average asking prices in Hudson Yards of $3,000 plus a square foot in a neighborhood that hadn't been established yet, that's really tough. So I would say Hudson Yards as a concept has been reasonably successful, but as a financial investment has been unsuccessful.
I think Hudson Yards is also like the positive story of the office market, right? It's their office was tremendously successful. And if anything, the retail did poorly, and they're turning more of it into office space.
Right.
There's actually not that much residential, right? It's two buildings.
It's two buildings,
Like 15
yeah.
Hudson Yards is done.
Yeah.
Or a couple penthouses left. Sure, they're discounting them, but I think they did totally fine, maybe flat on that project. And then 35 Hudson Yards has a hotel. I think that those were kind of more like vanity pieces of it. I don't think that those were actually meant to be like the leaders financially of the
And
project.
a lot of retail also, throughout the base of that. But
Yeah.
talk a little bit, Steve, about 421A tax abatements that have gone away a long time ago. And, I'm in new developments long enough to remember that when 421A first came out, it was a monster incentive for especially first-time buyers to go out there and buy up whatever they could buy up because, hey, I'm paying $45 a month in taxes for the next 10 years, whatever, raising incrementally, 20% every 2 years, whatever. I mean, now everything that comes to market is at full tax value.
It's not just at full tax value. Often it's at an overestimated tax value. As a
Or
matter of
even
fact,
that
at the
too.
Vanderwater, we just saw almost 40% reduction in our real estate taxes after our tax certiorari because the taxes were so grossly overestimated and overtaxed by the city. The lack of 421A is hurting the city in numerous ways. Affordable developers, actually rental developers, must develop affordable housing and get tax abatements to supply rental housing. Without a 421A, there are no new rental developments. So what are we seeing? We're seeing rents go through the roof, right? We're $100 a square foot on a new product is going to be the norm for rent in New York City going forward. Some of the projects that are coming up now in the financial district are projecting over $110 per square foot on average. So what this has done is it's, again, created a supply problem, which pushes people to the buy side because there's very little to rent because rents are rising so quickly. So you say, like, where are these buyers coming from? With this supply and demand fight, they're coming because what they're looking at in renting is not really affordable. So their parents and families are helping them buy to offset that. We need a 421A program for numerous reasons. And yes, it was beneficial for the condo market, but what it really did is it helped to create some stability in the housing market in New York City overall, and we're missing that right now.
The thing that people forget, though, is it wasn't an affordable housing benefit to start with. It was for all projects. This thing was, I think, launched in the early
Excellent point.
70s for
Excellent
that
point,
reason.
yeah. Right.
Steve Spinoli used to always remind people of this.
And after 9/11, to incent developers to come back to the
Then we had the
table and start
421G.
building.
Mhm.
Well,
Right.
421G actually started in the 90s.
They brought it
with
back,
the South
kind
of
of.
Brought it
Murray
back.
buildings.
Right.
Right. I mean, that's the thing. When people say this office space, you mentioned the vacancy rates. Now there's just under 100 million square feet of available office space in Manhattan. People say, well, let's make it apartments.
Not
Who's
so
going to
easy.
do that without any tax incentive?
Well, and you can't, and it costs so much to convert those buildings to residential. The windows need to be completely replaced because most windows in office buildings aren't functional. HVAC systems need to be replaced. The entire mechanical systems need to be replaced. Cores need to be drilled for bathrooms and kitchens. It's not so easy.
and old and outdated is chic downtown, but maybe not.
We look at 3 to 5 of these a week right now, and maybe 1 in every 100 possibly works. So, that's not going to solve the housing crisis anytime soon. Bringing back a real 421A program that actually incentivizes developers to build affordable housing, which is what this city needs, is something that will both help the condo market and the rental market, but most importantly, it will provide workforce housing opportunities for those that are coming here. We talk about population growth and job growth. Job growth is great, but if people can't get to work because they can't live near where they work, it doesn't really matter.
Yeah. Ari, the fall season has traditionally been a time for consumer to take stock of their home buying needs, whether they need to sell, buy something bigger, something smaller, buyers out there for the first time, etc. But I find myself checking out the pumpkins at the local bodega these days because, housing conversation ain't happening all that readily. So is this something the consumer is also doing, checking out pumpkins or, versus thinking about the housing market? And what is your advice or counsel to buyers who say to you, I want to buy now regardless? Because that's a big gray area.
Well, our business always revolves around, the D's, death, divorce, diapers. I always forget one of them, but, life goes on, right? People are getting married, they're getting divorced or having babies. The mobility of New Yorkers and Americans overall obviously is not what it was during COVID, where you sort of pulled forward all this demand and a lot of people made the move to the suburbs a couple of years ahead of when they might have, or, took advantage of hybrid or remote work or what have you. So, some of that kind of mobility was pulled forward, but overall, life continues to forge ahead and people have, housing needs as they relate to life. So, and unless you're dealing with someone, in unfortunate financial circumstances, they've got to live somewhere, they've got to own, they've got to rent, they've got to figure it out. So, I think the housing conversations are moving forward. I think right now you're in just a very weird, Greg could probably give more historical context to this, but you're in a very weird amalgamation of financial factors where, the equities markets are down, but still incredibly strong. The labor market is incredibly strong. Interest rates are at a 23, 24-year high, whatever they are today. Real estate prices in New York City, no one really wants to talk about this, by the way, but real estate prices in New York City are essentially flat since like 2015. We haven't even kept up with inflation. Real estate prices across the board in the U.S. are 45% up, since the start of COVID. So there's this really weird mix, and I think it's giving people a lot of kind of analysis paralysis. Your buyers are expecting prices to fall. You have sellers who are saying, my asset isn't, worth what I want it to be worth. I'm not going to sell. But ultimately, yes, the conversations are happening. People want to move. And for those folks who are really motivated, who either have the cash or the stomach to take on the higher interest rates, it's really about figuring out, what are your housing situation needs, and what are your alternatives. If you're in a 2-bedroom and you just had your second or third child and you need to move, you're either going to rent or you're going to buy. So what makes the most sense for you and your family right now? What can you afford? Where do you want to be? And I think one of the things that's changed in the last couple of weeks is the sense that, whether right or wrong, rates are going to persist at a higher level and they're going to persist for a longer period of time. And so I think hey, I'm going to refinance back into the 5s or maybe if I'm lucky into the 4s in the next couple of years conversations, those have kind of gone away. And I think more buyers today are expecting if I'm taking on 6, 7, 8%, whatever the number is, that's where I'm going to be. And I have to make my financial and housing decisions around that number. So, but yeah, the conversations are happening. They always happen. And if and when the dam breaks, good, bad, or otherwise, things will blow up as they always do in a positive sense.
I think there's also something else to consider. It's not just interest rates that are going up. Insurance has gone up. Real estate taxes have gone up. The cost of homeownership
There's been a big
overall,
decline in people getting homeowners insurance because they can't afford it.
We're going to talk about that in a
But you
couple
can't
of
do
weeks.
that in a condo or a co-op because your condo or co-op won't allow you to do that, right? So in general, the cost of housing has gone up across the board. It's not, and interest rates obviously are the biggest factor, but rise in insurance, rise in common charges and maintenance, these all have impacts on people's ability to own and purchase.
But there's this disconnect. They did a survey, this consulting firm, a couple of weeks ago, and they asked potential buyers, how low would rates have to go for you to buy? And they said 5.5%. And they said, why? Well, that's because what they historically are. And they couldn't be more wrong. The average 30-year conforming rate over the last half century is just under 8%. So there's also this misconception that you can't have a healthy housing market with rates in the 7s, that this is unprecedented, that people don't know what to do. And I'm not talking about, Steve can remember this because
listen, I had 12%.
He can remember
and I was fine.
he can remember 15, 16%.
I've been talking about this a lot with my peers because I'm sorry to do this, but I'm 32. I graduated college in 2013. So right now is when people should start buying their first apartment, logically, right? They've been in New York for 10 years. They're getting promotions. They're starting to think about it. And our entire adult life, unless you had parents that really taught you about the economy, rates have been 2 to 3%. The whole since high school, because we graduated in 2009.
Inflation has not been a problem for 40 years.
So it's crazy to try and think about buying in at 6%, 7% for a lot of these people that are like, oh, this is just a blip, it'll go back down. But it's a total, you have to reframe your whole thinking.
That is
this
absolutely
might be what it's going to be
correct.
for our whole life. Yeah.
Right. See, we, who are now 32, come to the table and say, listen, my first interest rate was 12%, okay? And I thought I was robbing the bank. Why did I say that? Because it was at 19.
Right, but you're also not, being pushed to buy a $3 million 2-bedroom.
Correct. No.
So that's
Right.
the issue.
And the purchase prices were, so low at the times.
Yeah.
But still, the interest rate, 12%, 11%. I mean, it slowly started going down. And my first co-op here in New York City, Upper East Side, 7% fixed, 30 years. And I thought, I just robbed the bank. That's amazing.
Yeah.
Right? 30 years.
Yeah.
And then it went down a little lower so I could refinance. And I said, okay, this was not a bad deal. I get the frame, the frame of mind. But let me ask you something, Ian. So Ari talked about the buyers out there. What about investors? What are they looking for today to make a successful transaction? When we all know the cap rates are not where they want it to be and everything is askew, what are the investor types that are out there looking to buy, say, right now? What do they want?
They're waiting.
They're waiting.
I have no one buying for investment.
Yeah, the
Zero
only investors I see are 1031 investors or foreign flight money.
But even that foreign flight money is so quiet. And I have sellers coming to me saying, oh, I have this renter, the common charges went up, we'd sell for a loss. I still tell them, unless that loss is so great that you don't even want to hear what that number is, there's no buyer for that. Yeah. It's just horrible. Why would you buy that when you could buy a T-bill for 5.5%, 6%? What's the point?
Clearly.
It makes no sense. It's
Steve.
not a good asset anymore.
Especially with the Airbnb changes, too. I mean,
maybe,
well, the new rent rules for Airbnb
Right.
are significant. I know.
I tell people to buy a house in Long Island or buy a house in Westchester and rent it out, and you'll do so much better.
They'll do well. Yeah.
They'll do well.
Yeah.
That market, by the way, is booming and zooming.
There's zero inventory.
Zero.
You'll do
And
way
whenever
better
something
doing
comes
that
on the
than
market,
buying
it's
a
gone.
Gone.
That's
I watch
because
my
Long
family
Island is
stuff.
the greatest place on earth to live. That's why.
If you like sitting in traffic all day.
I'm thinking about
Where am I
I'm thinking about
driving?
Westchester, not necessarily Long Island. But
So am I.
whatever.
I'm with
right?
you, Vince.
There you go.
There are trains, Steve, that carry us into. You take one too, so
I've always been somebody who would rather go north than kind of
Yeah,
like that
yeah.
south.
Okay. I like that I can bike 4 miles to the beach. The rest of you can just-
I will actually follow up. I have people looking to buy multifamily that just want to park money for
Yeah.
a long time because
Yeah.
they know they can get discounts. There are a lot of wealthy people in the city, a lot of global eyes on the city, but most of them think that it's going to fall further and there will be a time to wait to be liquid.
Steve, from afar, I have Nikki Field coming on the show in a couple of weeks, my favorite agent to talk about foreign buyers. From your perspective, where are the foreign buyers today in new condo developments throughout our city? Are they here? Are they not here? They're kind of touching a little bit, not touching it. Investor types, as Ian said, kind of sleeping, not really wanting to do anything. Are we seeing any foreign buyer significant purchases these days in new condo?
And we still see a significant number of buyers coming or the money coming from China. I would say that's really the predominance of the foreign buyer right now. But there's a lot of looking, there's not a lot of transacting, because as Ian was talking about, the numbers don't really match. Even though that
Right.
buyer really will take almost a zero return, they don't want to go negative. Now, we do see some buyers, particularly from China, coming in to buy condos in neighborhoods that are really have low inventory of rentals and have a kind of a very high economic base. So like Gramercy, Greenwich Village, where the NYU student can afford $6,000 for a one-bedroom apartment.
Yeah.
We are renting one bedrooms at some of our buildings like View for $120, $130 a square foot. Those could make sense. But other than the Chinese buyer, we don't see a lot of foreigners coming right now.
Yeah. Ari, from your perspective, how are appraisals going these days? I mean, usually in down markets, banks are a little more stern, and appraisals are not necessarily coming in where they should. Are you seeing anything there at all that's of relative importance to talk about, or are things just chugging along?
No, I think things are chugging along. I mean, I think it's pretty much status quo, given that prices have been really, pretty stable for the last, kind of year and a half. So, no, knock on wood or whatever I can knock on here. We haven't really had appraisal issues of note. Here and there you have something, but nothing significant, not yet.
Ian, talk about the luxury market. What are you seeing? So let's define for this conversation luxury, 4 or 5 million and up, probably all cash. Are you seeing a lot of that? Obviously, some of the numbers I said earlier get skewed because a lot of these higher priced apartments. And I think I read something the other day where $20 million sales across the country are breaking records, not just here in New York City, but across the country.
Yeah.
Talk to us a little bit about your client base, because I know you play up in that realm.
I think unfortunate reality of it is that the wealthy have gotten tremendously wealthy, like to a jarring degree when you see some of their balance sheets and how they've gone up over the past 3 to 4 years, regardless of what's going on in the economy. They are not building for that echelon of the market. And those people do not need to move. They actually tend to just collect real estate. So unless you hit their number to get them to move, they won't move and they won't rent them. So if you want to talk about a segment of the market that has no inventory, it's that really top of the market. And developers probably could do pretty well by building massive townhouses and massive penthouses, and they would probably do quite well. I will say that in the past month, those prices were very much sustained, and if anything, they were jumping a lot because people had the money to buy and people didn't need to sell. So they'd say, hit my number, and the buyer would ultimately kick and scream and then have to hit it. You saw some really banner deals. A lot of them happen off market. That's exactly what's happening. It's someone coming into the market, billionaire, something like that, saying, I want XYZ, I can't find it, and they have to buy another billionaire's apartment. So they have to pay them a crazy number for it. Now, people are getting a little bit exhausted, and they feel that they are maybe overpaying, and I think that buyer pool is negotiating a little bit harder than they were before, and they have more patience. There's also some new buildings that, brokers in the know or developers know that are coming to market in the next 2 years. Super prime Upper East Side, Prime Village, Hudson Square is that huge Zeckendorf building that will go up. So people don't necessarily feel anymore that they need to pay crazy premiums to be in a building that was just built or was recently built anymore.
Ari, your perspective on that?
In terms of the luxury market, or more specifically?
Luxury market, yeah, just in general.
Yeah, I mean, I think it's, as Ian was saying, it's a market where, for better or for worse, the reality is the wealthy have gotten, extraordinarily wealthy, and the extraordinarily wealthy have gotten mind-bogglingly wealthy in the past couple of years, and they have the funds to do what they want. They're not interest rate sensitive, and they're not interest rate focused, and it's not part of their lexicon. And so, they want what they want. There's a limited supply of quality housing. There's never much on the market. They're not forced sellers. And yeah, I think it's all true. The other thing I would also add, and this is, more relevant maybe to my day-to-day business, a lot of that wealth is flowing to the younger generation. So, one of the things that we're seeing is a lot of our buyers who are purchasing the kind of maybe sub-luxury segment, whatever you want to call it, 1 to 5, 2 to 6, 3 to 7, whatever it is, are young folks who are, they're inheriting their money. And unlike their peers who are, earning the income to buy at that level, but are very interest rate sensitive or focused or whatever verbiage you want to use, these are people who can just come in and write a check. And their parents can write a check, or they can write a check from their trust, or whatever the case may be. And so they are driving a lot of that, like 2-bedroom, 3-bedroom market, entry townhouse, Brooklyn townhouse market. And they're beating out the buyers who are either unwilling or unable to step up to a higher number based on kind of where rates are today, and need the financing. So, overall, if you look at the data, some of the law firms that I track, and Urban Digs, and some of the other sources, and Greg Heym data and what have you, you see that the percentage of cash buyers in the kind of entry level luxury market, whatever we want to call it in New York City these days, continues to rise.
And we see the same exact thing in the new development market. I'd say between $1.5 and $4 million, 7 out of every 10 buyers that we're seeing right now have assistance from family or inherited money.
Yeah.
Ari, from your perspective, talk a little bit about off-market. Ian also, there's always, periods of time where you see a lot more off-market stuff, periods of time where you don't see a lot of it. Are buyers actually out there asking for it? And if so, where are they finding it?
I think we have a huge off-market thing right now. It's the one thing I want to talk about the most, for so many reasons. One, people don't want to take up days on market.
Yeah,
2, people only want to sell if someone hits their bid. 3, people are frustrated with the inventory on the market, so buyers are going to ask for it. A lot of buyers ask for it. A lot of buyers in certain price points expect there to be a lot of things off market. They're wrong. Unless you're really at the top of the market, are you in a scenario where you can find a lot of inventory off market, and even then you're usually finding things that are not priced in accordance with the market whatsoever. It's more people just dictating make me move offers. I do have a certain amount of clientele that are would sell at market numbers but don't necessarily want to advertise for certain reasons, whatever. They work from home, they have a baby, they have a renter in there. So they just say, listen, keep it in your back pocket. We're not in any rush. When interest rates come down, we think we'll be in a better scenario. We can actually list it live then and really do the whole push. But right now, I think just hold it in your pocket. And if you run into a buyer that wants to buy it, you can bring them to us. I also, frankly, think that it's a way that brokers are protecting themselves against the technology taking their business away from them. And I think a lot of people are just choosing to say or hold things in their pocket off market so that they have to be personally connected to other brokers to get deals and not put things on Street Easy, although that's an unpopular opinion.
No, but it's a fact.
Yeah.
I mean, it's an absolute fact, and that's, I think, one of the things that where agents fall down a lot, because if they don't have those connections to those off-market properties, or anything other than the norm, they don't really have a place to look. Mm-hmm. So that's a very valid point. All right, listen, we've got to take a break, so we'll come back in a few minutes. In a second, don't go anywhere. We'll be right back. Okay, Steve, I wanted to ask you, so what about the potential repeal of the SALT cap, which depressed prices in New York City by probably 11% or more, and maybe you have a better number on that? We all were kind of infuriated when that began a few years back in a previous administration. Has been talked about, again, about a repeal, but I haven't seen anything, I haven't read anything about that happening. What is your opinion on that? And by the way, how will that, I hope to use the word correctly, jumpstart our market again?
Well, I think if we were to get back what we lost in the SALT tax deductions, I think it would be a boom for the real estate market. I think a lot of people saw that benefit go away and said, well, now my benefit to buying a home isn't what it used to be. So if I can rent, maybe I can rent and put my money to work someplace else. So to me, that would be an immediate help to the market. And frankly, I think the current administration would be really wise to try to get that done, but you'll never get it done with a split House and Senate.
It's not going to happen. I'll tell you why. First of all, it could have happened already. They had the control to do it. What people neglect to realize, first of all, it's set to expire in 2025 because that's the way tax reform had to be done to get passed. But
that's when taxes go up on everybody.
With the exception, right. Well, I at least you're acknowledging that the taxes actually went down for the vast majority of people. The problem is that the Democratic senators who aren't from New York, New Jersey, and Connecticut have no interest in it. It's not on their radar at all. And that's why it didn't get done when it could have been done. There was a big push from New York representatives, obviously, to do it. It depends on the political
Well, they were gerrymandered
landscape,
out.
who's controlling what at the time. But I think even if the Democrats had full control, the odds of it coming back are slim to none, in my opinion, because they could have done it before and they didn't. So I don't know what would change their mind.
Well, I think going into an election year, if Democrats did have control with rising interest rates, they would find a way to bring it back because it would soften the blow that real estate has been hit with rising interest rates. But it's not going to happen. It's not going to happen with a split House and Senate, and it's not going to happen while we have so many other issues to attack in this country. Right?
I mean, we can't even fund the government. Let's take it one step at a time.
Well, we don't even have a speaker.
Yeah, well, it's maybe by the time this airs.
The
I
kangaroo
don't know.
court over there.
I'm available, by the way.
Maybe
if
by
they
the
want.
time, okay, tomorrow morning. Let's see if we have a speaker. All right, so we'll end with this. So what, Mr. Economist, is your prediction? We are officially into the fourth quarter of 2023. So for the end of this year, keep in mind we're going into a presidential election year in 2024, which is a few months away.
That's always
fun.
fun.
I know, but where are we going at the end of this year, and what do you predict into next?
Not a lot's going to change in the next couple of months. The economy is still doing better than expected. We're going to get a third quarter GDP figure in a couple of weeks. It's expected to be a blowaway number.
Correct.
Probably pushing close to 5%, which would be the highest rate of growth in a couple of years. So I think we have to think more about what happens next year. The economy is going to continue to chug on, but I think at a slower pace. I think consumers have to be running out of money. And now that student loan payments have restarted, although, we had another big forgiveness, but there is still that's a huge amount of payments. And a lot of that money, people admitted they'd already spent, anticipating they weren't going to have to pay their student loans back. That, the reduction of the pandemic savings to next to nothing, the credit card debt that people are under, you can't help but expect to see the economy slow down. I think it will take longer than we thought. I'll admit I was wrong. I thought we were going to have a recession right now. But that at the beginning of the year, it looked like we'd run out of gas about now. I'd say it could be another year till we actually see a recession, if we are going to see one. The Fed may get its soft landing. Unfortunately, none of this is really great news for real estate because it doesn't mean any significant move in rates for the next year and a couple of months. I don't really see a lot happening. You could see if we did somehow go into recession quicker than expected. Recessions are good in the fact that they reset home prices quickly and they get interest rates lower. And I think we need both in many, not just here, in markets across the U.S. So a lot of the same. And obviously with an election, expect the volume just to get ramped up big time. And expect, the Jets to miss the playoffs because as much as I love my Jets, it's just not going to happen.
Well, I think all those economic factors are really important, but I think the most important thing really for this city, because New York City, people buy, sell, rent in New York City in all markets.
Correct.
Quality of life issues are the biggest things that I think our city needs to address. I think we need to find a way to address the homeless problem in our city. I think we need to find a way to address some of the blight that's occurred with retail being more vacant. I love outdoor dining, but getting around the city now is really difficult because you can't get across town because every restaurant has something blocking the street.
Yeah.
I think quality of life issues need to be addressed. The economy, ultimately, the economy works itself out, right? Sometimes it takes longer, sometimes it takes shorter. But
I'm glad you have that confidence in it.
Well, you just said it. You thought the recession was coming this year. It'd probably come, sometime next year if it comes at all.
Comes, yeah.
But everyone wants to be in the city as long as the city is livable. And we've got some real serious issues that this mayor has to address.
Rats.
And I really hope he's up to the task because so far he's been disappointed.
All right, last question. Are kitchen table issues the real issue that is stopping the consumer? I mean, consumer sentiment is kind of at an all-time low. GDP numbers, you say, are going to raise. Inflation has been coming down a little bit. Job numbers have gone up. So when you look at everything out there on paper, it's like, okay, so we're heading in the right direction, okay? But yet, even especially when it comes to elections, presidential elections. Everybody says to me, but Vince, it's the kitchen table issues. It's the if I hear my brother tell me one more time, the price of gas, the price of groceries, I don't understand. But so what? So
well,
what?
Consumer confidence and sentiment is driven, you even mentioned before, by gas and food prices, things that people buy all the time. That's what they notice. My grocery shop used
It'll
to
change
be
maybe.
$150. Now it's $250. Like, look what this costs. Look what that costs. I think, again, that goes to the point where you have a great economy. Jobs are plentiful. We have almost 10 million jobs. We can't find anybody to take in the U.S. It sounds great until
Isn't
people
that novel?
look at how much money they're spending for everything. And, gas prices are very volatile, and food prices. That's why we typically don't look at them when we look at the inflation numbers. The problem now, and why inflation has been so stubborn, is the core inflation that doesn't look at gas and energy prices is rising faster right now than regular inflation. And core inflation takes longer to come down. So whether it's people's housing costs, which is more than half of the inflation that
Correct.
people pay, and just the stuff that they need to buy every day. I mean, restaurants are still doing tremendous, even though people are squeezing it. But I look at my restaurant when I get my check, and especially since in Long Island, it doesn't seem so prevalent here. Long Island, they're tacking on that credit card surcharge.
Everywhere.
Yeah, the restaurants I eat around here, I don't see it, but
Well, they just bumped up prices and stuff.
Right.
They were smarter than the guys on Long Island.
well, because they give people the option.
Because I
you
hear
know.
people yelling at me,
Yeah.
I'm not paying 3.5%. No, take that off my bill.
Right.
In Manhattan, they just raised prices.
Right.
Well, now our
raise
menus
raise
have
the
the-
price of the food.
They
That's
list
all.
the price both ways on
Yeah.
menus now in Long Island. That's what it's come to. So it's always kitchen table issues because that's where people vent. That's when people, you don't
Right.
talk about what makes you happy at dinner time.
Right.
You talk about what's upsetting
And
you.
now social media just takes those kitchen table issues and explodes them, right? So they all become larger than life.
My final comment on kitchen table issues is this. Those are the things that throw elections usually in the wrong direction, right?
Well, I think for Greg, it would depend what you think that wrong direction is, but I think
Right.
you and I are on the same page.
Right. and I love both of you. Okay,
He says that now. We'll see later.
good. My thoughts are next. All right, for my thoughts for this week. Before the COVID-19 pandemic, the New York City real estate market was experiencing steady growth with increasing property values and a high demand for both residential and commercial properties. We were starting to come out of several years of an administration in Washington that lowered taxes for some and raised taxes for others. New York City real estate property taxes began to raise at unbelievable levels, creating a pause in the new condo development sales market. During the pandemic, there was a slowdown in real estate activity across the board as restrictions and lockdown measures were implemented. Many buyers and sellers put their plans on hold, resulting in decreased transaction volumes. Additionally, the rental market was affected as many people moved out of the city temporarily or even permanently, leading to an increase in vacancies and a decline in rental prices. However, as the city began to reopen, the real estate market began showing signs of recovery. There was a resurgence in activity while increasing interest from buyers and renters. The low interest rates at the time were also made easier for buyers and borrowers, very much more attractive, stimulating demand. By mid-2021 and into the first quarter of 22, we started seeing a flurry of activity, high purchase prices, sellers happy with bidding wars again, and buyers paying over the asking price. This continued in resale activity and in new condo developments. You could not produce enough inventory to satisfy the insatiable demand that buyers placed on our markets. Like the old saying goes, all good things will eventually come to pass. Indeed, by the end of the first quarter in 22, the Fed Reserve began to raise interest rates at levels and speed that caught buyers and sellers completely off guard. It would take the balance of 22 to eventually see that we were headed for trouble in real estate nationwide. The housing market has been hit very hard by the nation's inflation, overall pricing, and consumer sentiment. How does this change? Well, we attempted a few solutions today in our talk, but overall theory is that it will change, markets will rebound, but not until after the next presidential election cycle in 2024. And thank God this isn't a political show, or I can go off for hours. We will stay tuned on all of this, and as always, we will report as needed what our findings are. And one last thing, everyone here at Talking New York Real Estate stands in solidarity with Israel after this brutal, horrific, and unnecessary attack by Hamas. Our thoughts and prayers go out to the families of the deceased, both in Israel and in our country. may they find the peace that is needed in the coming days or weeks. And for all those who died, may they rest in peace, and may their memories be a blessing. Am I going right into close on there or no?
This is
No, done. Okay, so then we'll just go to close. And that's our broadcast for today. Thanks for listening, and thanks to my guests for being here on set with me. You can always follow me on Facebook, on Threads, Instagram, or TikTok at Vince Rocco, or my website, thinkvince.com. Oprah Winfrey says, if you look at what you have, you will always have more. If you look at what you don't have in life, you'll always never have enough. And to my listeners all around the world, from all of us here at Talking New York Real Estate, thanks for spending a part of your day with us, and we will see you next time. Goodbye, everybody.